Welcome to Subramani. Please subscribe. Please hit the like button. Please press the bell icon. Right, my subscriber base is not increasing at the pace at which I wanted to increase, and my base is increasing on Twitter. And on Twitter, I'm just having fun, right? So don't take me too seriously on Twitter. Take me very seriously on YouTube. So this is one such serious topic that I was reading a JP Morgan report. I also read a Morgan Stanley report. Maybe it's a little dated, maybe 7-8 months old, showing that in the US, the home office, which means what wealthy people create their own investment teams, and it's called family office. These people have invested, hold your breath, 46% of their money in alternative assets, not in direct equity, not in equity, not in debt funds, etc., but in private assets, right? So what we call as alternatives. So the sizable allocation to alternatives, which includes private equity, hedge funds, real estate, extra credit risk funds, and then all these kind of private equity and all that stuff, and that is where they invest. So is it do you need all that to get rich? Somebody approached me with about 1,000 crores to invest, saying I want a portfolio created, and I said, look, you don't need any portfolio. You have enough wealth, and so just put this much in a gilt fund and you will not do too badly because you've come at the right time. But then he did not want that. He wanted a very complex solution with REITs and private equity and private credit and things like that. And I said, look, I don't do that stuff. Since you asked me, I'm telling you that a simple portfolio will work. But nobody wants a simple portfolio. That is also something which I've seen, because what happens in a family with, say, 1,000 crores to invest, there are some 10 people, out of which one kid has been assigned this task of looking after this 1,000 crores. It's a family office, like they say. So in the family office, this boy wants to take credit for all that is happening. So he wants a very diversified portfolio which he can sit on a Sunday of every month. One Sunday is picked up where he analyzes his portfolio, he discusses his portfolio just like a portfolio manager would do with his client. He is now treating his family as a client, not as, he is not representing the family as I think he should. But anyway, so if he said, I put the money in a gilt fund, and the gilt, because interest rates went down, we made 8% or 9%, and I took zero risk. Do you think the family is going to like it? They're going to say, oh, this guy is too lazy, right? But so he wants REIT, he wants international REIT, he wants international stocks maybe coming through a mutual fund, which is safer because you avoid the estate duty of the US. He wants real estate, he wants a house given on rent, all that within that 1,000 crores, so that he can have something to talk about. He said, this is what happened in REIT, this is what happened in equity, this is what happened in private credit, right? So that kid also wants it. It is not as though that kid does not want. And the persons he employs also want to have fun doing this. So everybody wants a very complex asset allocation. But typically, what are the things which we call alternative assets? First, private equity. I'll come to what is wrong with each one of them. Then venture capital, which is again like private equity, but private equity is perhaps a little later stage. But yes, venture capital, hedge funds. You can go and put money in a hedge funds. In India, it's not very easy, but you can always do it through your LRS. You can do it in Singapore. You can do it in US. So you can do that. You can put in real estate. You can do private credit, and of course, then there is collectibles, which are intangible, which are tangible assets like art and things like that. The benefit is, technically, it is supposed to be less correlated to the traditional financial assets. So they believe that when equity markets fall or when debt markets fall or whatever happens, then the alternative assets won't fall. I honestly don't understand that claim, but they are saying that each of these assets which we mentioned, like private equity, private credit, etc., it has a different correlation with stocks, bonds, cash, which are your other investments. I mean, it could be a debt mutual fund if not bonds, right? The hope is is that these alternative asset classes will provide a diversification benefit that you cannot get elsewhere doing anything else. So therefore it is necessary. However, please understand these benefits don't come free. They come because your managers want to do it, so it's a little more complex. So your manager's salary, you run a family office, right? So your manager's salary and the commissions and the fact that these transactions will be brought to you by an agent. Your people don't have the ability to source such deals directly. I mean, it is not expected. So all the costs remain same, plus the further costs of alternatives tend to have higher fees and higher minimum investment than traditional assets, and perhaps even a higher lock-in, right? So what are the, so many alternatives will, first of all, they are less regulated, then they are less monitored, because if you put money in, say, in HDFC Focus 30, and HDFC Focus 30 is not performing for whatever reason, thousands of people will talk about it and say, oh, last year it had such a high alpha, this year it is not performing, etc., etc., etc. I mean, it could be any fund, because if it's a fund with, say, 20, 30,000, 40,000 crores, there's a good chance that many people have invested and the others are watching. They will talk about it, and since 4 people are talking about it, somebody will write an article, some financial journalist will look at it, and the fund manager will give an explanation, right? But that is not true in your private asset allocation that you do, right? So where have they invested in the US? So let me just give you those numbers. Private equity is 17%, real estate is 15%, hedge funds is 5%, venture capital is 5%, and private credit is 4%. This is how the Americans have broken up. If you take India, it could be somewhat similar. I have no clue, because we don't have enough data about Indian family offices. There is some data, but not enough data to be able to do a deep dive and find out where they have invested their monies. On the real estate front, of course, wealthy people think that they should buy houses and give it on rent, and I've seen recently all the people I know who have invested on that ECR road in Chennai have all sold at a huge loss, because there's no secondary market. Sorry, I'm digressing, right? So when you do all this, what are the advantages, what are the disadvantages? Well, disadvantage is very clearly that it is illiquid. It is not as liquid as your HDFC Bank or Reliance or things like that. It is not liquid. Secondly, more importantly, look at it this way. You have bought some venture capital, you have invested in venture capital, you bought a share at 10 plus 90 in 2000, whenever. 4 years later, your manager comes and says, sir, we bought this at 100. The promoter is saying we will buy it at 140, and I think that's a good price because it is illiquid, nothing is happening, blah, blah, blah. So you give it off at 140, or even worse, you have bought it and your manager is saying, sir, there is no liquidity, but it will do well. I'm sure we will be able to sell it off at 300 or 350. He's been telling you this every quarter. Is your employee or is the agent through whom he has bought it? Because an employee at some stage tells the agent, boss, my boss is shouting, so please come and meet the family. So then you go, the guy comes and meets the family, and he says, no sir, don't worry, don't bother at all, they'll sell at $300 or $350 or something like that. Then after a week or 10 days, you pick up and you see that you have invested in the venture fund, and that venture fund has invested in this, and you are happy that the company in which you invested, at which that manager told you will sell at 300, has now placed some shares in the next round of funding at 550. So you are very happy. You call up the manager and he says, sir, but last week we gave it up at 140 because we thought that there's nothing happening, so we gave it up at 140. Now comes the crux. Did your manager cheat you? Did the agent cheat you? Or did the owner of the company cheat both of them? You will never know, because the back end for most of these alternative assets is not subject to public scrutiny. So if somebody comes and tells you that he bought shares in subramani.com for 10 plus 990, he's right. Somebody could have bought it for 9990 also. You have no clue to know at what price the shares got placed. That's why I'm not naming them, right? So, and there's another fraud that can happen. I can get listed as an SME, and after 3 years I'll go to the main bourse without any IPO, right? This is another thing which is happening. So you can invest in all these companies, and these companies are largely laundromats which are there to launder your wealth. So ultimately, the key to building wealth is not some specific asset, not a specific form. I'm not saying don't invest in equity. I'm not saying don't invest in real estate. It is in the power of consistent, disciplined investing over time in a good quality asset, good quality management, trustworthy agents, trustworthy managers. If you're the rich man who is appointed employees, they're trustworthy employees. It's a combination of all this. So when you don't get some of this right, for example, for me, alternative investment, the problem is liquidity. I can't, these things are not liquid when you want it. I'm willing to sacrifice liquidity if there is transparency. Here there is no transparency, there is no liquidity. So the strategy adopted by a rich man may not be the one which suits you. I remember once we had gone to a syndicate, a meeting where I was representing a company which was to give loan, and they said, oh, so and so has given loans. So I smiled and said, he knows how to recover it, right? I don't know how to recover it, so it's not suitable for me. So just because a big guy, just because a Dhoni has invested or something like a Yuvraj has invested, does not mean you should invest, because when push comes to shove, these guys can call up the Prime Minister, the DGP of police or whoever it is and recover their money. You won't be able to. So be careful about these things. Do you need this at all? The answer is maybe you don't. But even if you get it, make sure that you put a small amount, that it is liquid, you are able to buy and sell. You know why the promoter is buying, selling, whatever. Unless you know everything in the transaction, don't go anywhere near it. Thank you.